Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
All right, welcome back to our podcast. Today, our guest is Jonathan Sparks, the founder of Sparks Law. Jonathan has been a guest with us before, and we welcome him back. Thank you.
Oh, hey, thanks for having me, Gary. Really a pleasure and an honor to be here. Today we get to talk about, I guess, the history of corporate law, which is, my favorite topic.
Great. So, speaking of, last time you told us, some of, why you decided to get into law and so forth. Why was it that you really decided that business law was really what you wanted to do?
So I just had a passion for it, I don't know if it's because I was raised in this entrepreneurial environment. My dad started a company in 1988. He was a doctor, and he found a need for training for the boards because doctors would typically take a year or two off of work just to spend the entire year studying for their board reviews. So he came up with this company that would help train them, and nobody was doing it at this point. So it was everything was written from scratch on an old IBM, and we had the letter. That was back when we had the yellow colored everything in DOS,
Right.
Soft Windows wasn't even out yet. But yeah, we were licking stamps, when I was, a first grader or something for mail outs, the old school marketing campaigns. But, growing up in that environment, I saw, unfortunately, a lot of legal struggles that they had. And, when I went to law school, I was just really, asking a lot of questions about it. I loved corporate law classes, all of that. And I realized that there was so many legal fixes that my family could have done had they had good legal advice. But, they didn't at the time understand that you could hire, a business attorney to help. And, they unfortunately got into some trouble. They could have easily been disputes for their businesses and things like that. So, I realized that there's a real lack of good expert legal advice. I'd say there's a lack of good expert tax advice as well. But I can help with the legal side of things, and that's why, do what you love, right? Do what you enjoy.
Right.
An endless amount of energy if it's something that you care about.
Right. So, going back, you're talking about your parents and saying that there's, different things that they could have done if they would have had the right advice and stuff. So talk to us about, the different types of entities that someone can get structured as.
Sure. So we're just going to kind of go back in time a little bit, I think, so that, our listeners can really understand how limited liability was developed as a legal technology, and why it's so important,
Okay.
and why these things are important to have in place to maintain it. So back in the 1800s, we did not have limited liability. Limited liability allows you to invest into a company or multiple companies, and then if that company goes south, if something really goes wrong with the company and your investment, you can just leave that company and sort of have a sunk cost for whatever your investment is, but you're not liable personally for anything that the company did wrong. So if back in the day, you would have factories, with the Industrial Revolution, you got a lot of investors investing in factories or railroads and things. And if something went wrong, if the factory blew up, God forbid, and everybody would want to sue the owners of that company for tens of millions of dollars even back then. But you could walk away from that investment because the company just went south. And that's kind of an amoral example, but
Right.
what limited liability does is it allows you to invest without, concern for your personal assets. So your house, your inheritance, your trust, your estate, anything like that, your cars, savings certainly. So limited liability is a huge deal. And when they first came out with it, they only offered it with a very highly scrutinized set of corporate laws. So the only way you could set up limited liability is with a corporation. And you needed all these bells and whistles. And most of these laws are still on the books, this sort of red tape stuff. So this is where you hear about a set of bylaws. This is where you hear about a shareholder agreement, which is basically a partnership agreement. You have voting trusts sometimes. You have different classes of shares. You have printed shares sometimes, which I think we talked about last time. You have to set up a corporation, you have to do organizational meeting minutes that are recorded by the corporate secretary, which may or may not be the one single owner. It might be, someone else on the board of directors. You also need a board of directors. So, and this is just kind of touching the surface of all of the things that you need in order to set up a corporation successfully. If you don't do any one of these things, people get to what's called pierce the corporate veil. So they make the argument in front of the judge. This is, let's say you have a rental property that's held by a corporation, okay, and you're renting this out to, Sally and Bobby, who are your tenants, okay. So Sally and Bobby have, their grandmother come over, and she's a high net worth individual, and she slips on the patio for your house, and you didn't tell them about some slippery thing when it gets icy, and she dies, unfortunately. Her estate can sue your company, and they will try to sue you personally, okay? If you have a well-maintained corporation with all of these things in place, they cannot pierce the corporate veil and come after your personal assets. They can only come after what's in the business bank account. But she can get the value of the real estate property, but that's it. So if the lawsuit is for, for example, $5 million, and the real estate is only worth, say, 250,000 or 300,000, then all that she can get is that value. Does that all make sense?
Yep.
Okay.
So so you talk about that with in this that we're doing, long as you maintain the corporation properly. What is it that we need to do? So, taking a corporation, for instance, what do we need to file to get started as a corporation? Then what do we need to do with the corporation to stay in good standing, I guess?
Yeah, right. So the whole goal is limited liability. So if you have everything that a corporation requires to maintain, which is more than the other types of entities, which we'll get into in a minute, then you will benefit from limited liability, and that grandmother that died on the patio will only be able to sue for the value of that company, and your personal savings, car, house, everything else in your estate is protected, is limited from that liability. Okay. So what they did in the 80s typically was, they had some other alternatives in the 70s, but mainly this didn't start until the 80s. They started coming up with simpler versions of limited liability companies or types of companies, okay? Because up until then, the only type of company that had limited liability was a corporation. And corporations, of course, as you know, suffer from double taxation, okay? And they have all of these legal things that are just, a pain to put together, because you need, like you asked, you need bylaws, you need organizational meeting minutes, you need a shareholder contract, you might need a voting trust, you might need multiple classes of shares, you need a stock ledger. I could go on, right? So it really takes a team of lawyers to put all of this together. often, and it's just expensive, you know. So when they made it in the 1800s, they didn't want to give limited liability to just anyone. They wanted only people who, you know, had a professional attorney, were super savvy, and could just do it all. And for better or for worse, that, you know, kept out, that was sort of a gatekeeping mechanism that, you know, did not allow a lot of people to get limited liability. They just couldn't afford it, right?
Right.
So in the 70s and 80s, we started to streamline this process with alternative types of entities. And this is where we started to come up with limited partnerships, or limited liability partnerships, or limited liability limited partnerships, LLLPs. We had professional corporations, which were a little different, so PCs, and a lot of different versions of this, until we basically figured out, you know, the science to it, and we streamlined it really well, and we came up with the LLC structure, which stands for limited liability company. Limited liability companies have all the greatest stuff from a legal and tax perspective, and, you know, the lowest cost, most efficient, you know, stuff too. So you don't need bylaws, you don't need a ledger, you don't need all of these things that you need with a corporation to have an LLC and maintain your limited liability. But you do need one thing, which is called an operating agreement. And that's it. It's basically a partnership agreement. You do need it if it's just a single member owner, if it's just one person that owns. But as long as you have that, you're good. Unfortunately, though, nowadays, people don't even have that.
Right.
Which is a shame, because it's not expensive. It's not a big deal. It's a pretty easy thing, you know, for lawyers to put together. But if you don't have it, then you still don't get limited liability, even if you have an LLC company. Then they are liable to pierce the corporate veil.
So in that articles of you know, you file your articles of organization to get started, then you're saying you need this operating agreement. What does the operating agreement, in a nutshell, what does it say?
So it's less important what it actually says, and more important what it does.
Okay.
And so if you're just a single owner, it just says, you know, I'm an individual, taxed as an individual, and over here is the separate legal entity, which is a legal fiction, right? The separate legal entity that doesn't have a human, is not a human being. But there's a wall of separation between me and my company. So if something goes wrong with my company, or if I want to sell my company to somebody else, then, you know, there's a wall of separation. So I coexist, and I'm separate and independent from the company. It used to be that if you have, you know, a solo practitionership, or a sole proprietorship, you are personally liable for everything that your company does. You are the company. It's all
Right.
your reputation. So if somebody sues you, and you're you know, an entrepreneurial type, and you own interest in a bunch of other companies, if you do something wrong, or, you know, something that, you know, gives rise to a lawsuit, even if it's not wrong, if you lose that lawsuit, they can go after all of the companies that you own,
Mm.
right? Because you own them.
Right.
So you're liable for all of that. So it's a scary situation. So the operating agreement sets up the wall, legally speaking.
So what you just said kind of triggers something. So if I own, you know, whatever, 5 different businesses,
Hmm.
and you and I are in business together in some other entity type thing, something goes wrong with one of my sole-owned businesses, and I don't have an operating agreement, are you saying that they can possibly come after the business you and I own together because I'm the owner?
Yes. So the laws on the books, and we get this through British common law, which we sort of took over, you know, when we seceded,
Right.
but also our state laws. We have what's called general partnerships. And general partnerships are the scariest thing in the universe, because anything that your partner does in any way involving commerce or business, or even, you know, moral turpitude, you are jointly and severally liable for the decisions of your business partner. So if your business partner is, unbeknownst to you, you know, a gambling addict, and, you know, he goes out and he, you know, drops like the ownership to something that you own, and he's liable for $1 million, you're liable for $1 million because you are a general partner with him. And it used to be that you know you had all these restrictions on, people did not want to enter into a partnership ever because you really got to trust this guy.
Right, right.
But now, obviously, we have a lot of business partnerships that don't have that kind of risk, but the way that you limit that risk is by having separate legal entities that you own a portion of that is not treated as a general partnership. Instead, it's treated as a partnership with a limited liability company or a corporation or whatever else. But yes, I mean, if we decided to, start a business and we did not set up a corporation or an LLC, anything that I do in any of my businesses, you're liable for, and vice versa.
So another thing that you touched on, you know, if I'm a sole owner of a business, as an LLC, I'm reporting, if I don't do anything else, I'm reporting everything on a Schedule C, which obviously, yes, I have the liability protection, but it doesn't give me the tax benefits that I want or that I think I'm going to get. So how can I, help myself by changing, what do I need to do to be able to change it so I get the tax benefits that I want?
So, please correct me if I'm wrong on this, because this is really, I mean, you're more the expert on this than me by far. But as far as I understand it, originally with a C corporation, you suffer from double taxation. So that means that the corporation, let's say the corporation makes $100, it gets taxed at, whatever that rate is. So maybe 20%. So you're left with like $80, right? And then they're taxed again a second time on that distribution at whatever tax bracket they're in. So, maybe you're left with $50 or $60, or less. Whereas if it was only taxed once, then you would have, you would net like $70 or $80 instead of just 50 or 60.
Right.
So with LLCs, they allow for what's called pass-through taxation, where it's only taxed a single time. That's all correct, right?
So yeah. So you're correct. If you're a C corporation, you end up paying tax on whatever the profits are, and then when you take your dividend from the company, you're paying tax on it again. And then with a single member LLC, you're a disregarded entity. You're treated like you're sole proprietor, so you pay off the self-employment tax.
Right.
What I guess where I was going more is, lots of times with our clients, when they come in, they've structured themselves as an LLC, but that's not what they truly want. And because they want to take a paycheck, which as an LLC, and you're the owner, you're not allowed to take a paycheck.
Right.
So lots of times for tax purposes, we convert them with the IRS or petition the IRS to treat them as an S corp for tax purposes, which then allows them to take a paycheck and so forth. What is it from a legal standpoint? What is it that we need to do from the LLC? Because if I, petition the IRS to treat as an S corp and they grant it, now do I need to go out and do bylaws? Do I need to get a new federal ID number? What do I need to do from that side of it?
I see what you're saying. Okay, so that's a great question, and it's really important. There are a lot of professionals out there, lawyers and CPAs, that don't totally understand this, and that's a shame because it creates more uncertainty for a business owner. We all know that business owners have plenty of uncertainty already, right?
Right.
So yes, so it actually doesn't make any legal difference. There's not anything new that you need to file or do if you convert your company's taxation from a sole proprietorship or whatever it is, even a Schedule C, to a sub S corporate tax structure. So the IRS doesn't really care how you want to be taxed for your company and yourself. You could, I believe, have a sole proprietorship that's taxed as a C corp, although that would be kind of ridiculous.
Right.
But yes, I mean, my LLC, I'll just disclose this, information, but my LLC is taxed as an S corp. I don't have anything in my corporate documents or binder that have anything to do with a corporation, because it's not a corporation, it's an LLC. It's just between me and the IRS. They're going to treat me exactly like a corporation with a subchapter S designation.
So with that, then when people are filling out paperwork, loan agreements or whatever, they're still saying that they're an LLC,
Yeah.
and their operating agreement is what is still dictating what they have to do, correct?
Yes, correct. So the operating agreement is basically the new streamlined version of what we used to call your corporate binder. So it has completely replaced the bylaws, shareholder meeting minutes, annual meeting minutes, all of that stuff, all of that red tape, with
Okay.
one agreement that you just sign, and yeah, you can put it in a desk and not really do much with it, unless you get sued. But you don't need to change anything in that. You do need to file your annual report with the Secretary of State's office in the state that your business resides, and we can talk a little bit about that if you'd like. But yeah, you don't need all of that other corporate stuff.
Many times I have clients come to me, and they want to start investing in real estate.
Yeah. Uh-huh.
And they're like, oh well, my next door neighbor told me I should set up a corporation and put my LLC, or put my put this property in a corporation.
Right.
So is a corporation the right entity to put that in? Is it an LLC that's the right entity? Do I need to do it? What's, from a legal standpoint, what do you think is the best thing from that?
Okay, so we've got all of these things. We've got the legal standpoint, which is mainly limited liability. Then we have the cost benefit analysis, and then you got taxes too, which is kind of cost benefit, but all of this.
Right.
And to further complicate things, every state's laws are slightly different, so
Right.
it depends on where you're at too. But for the most part, you absolutely should get some kind of a limited liability company for any real estate investments, because of that scenario we just spoke about, which is actually quite common.
Right.
Personal injury law is a big deal. That's why you see so many billboards with lawyers, that are like, call, the strong arm or whatever his name is.
Right.
I love traveling because, we just get to make fun of all the lawyer billboards. Why do they do that, right? They do that because it's very profitable, and it's very profitable because a lot of people don't set up limited liability companies or the like for their real estate investments, and among other things. Okay, so yes, I would definitely recommend an LLC or a corporation from a limited liability standpoint, so that if somebody gets injured on your real estate, you just lose the value of that individual real estate. You don't lose all of your other investments, and the bank gets first priority on the value of that real estate too. So if your equity in the real estate is, say, 70 grand, then the maximum that you could possibly lose from that investment is 70 grand. You can't possibly lose any more, as long as you hired a good lawyer to set up your LLC and manage all of that, like us.
Right.
Okay, just getting it in there. Okay, so from a tax benefit, a tax and cost benefit analysis standpoint, you could set up a corporation. I think mostly they're sort of confusing, S corp designations, which is only between us and the IRS, like
Right.
we talked about, with an actual corporation. But between LLCs and corporations, it's always cheaper to set up an LLC. The only times that I'm recommending a traditional corporation is if they're considering taking like a tech company, public. So
Right.
releasing it on the New York Stock Exchange or NASDAQ or whatever it is. In that case, yeah, there's a bunch of special things we need to do. But 99.99% of the time, these small business owners only need an LLC. It's also very common that I'm asked, if they should set up a separate LLC for every property, or if they should sort of bundle some properties. My rule of thumb is just, once you get over 100,000 in equity that you own in various properties, I would park it in a new LLC, because I don't want to lose more than 100,000 worth of equity should something go wrong.
Okay.
The risk to this is if let's say you have 5 properties that each has, just 20,000 in equity in it, and the banks own the rest of the equity on a mortgage loan. Then, if something goes wrong with one of these properties, they could sue to get your equity in the other 4 properties as well as the first. So, they could then get 100,000 worth of value, and it's up to you. If you really want to protect your limited liability, if your threshold is more, 50,000 total or even 20,000, that's up to you. But as a rule of thumb, I like the 100,000 equity where I put it into multiple buckets. So if I have 200,000 in equity, I would have 2 LLCs that own, maybe 10 properties that each has 20,000 in it, if all of that makes sense.
So now this is going to be a silly question, but I've seen it many times.
Sure.
I own a rental property.
Awesome.
And I've now heard, oh, I need to set up an LLC for it. I go set up the LLC. Am I done?
No. So, but a lot of people get that advice, and I think it's the advice is has good intentions. Then even if it's just you that owns it, there's a very good chance that you won't be able to limit your liability should something happen. So if you have that $5 million personal injury case, or if you get sued by your tenants, for I don't know, mold issues or asbestos, or like something that you didn't intend, you don't want to be personally liable for that to where you need to file bankruptcy to recover, right? You don't want to owe somebody $5 million for something that you didn't know about and didn't expect, and you had good faith intentions the whole way. And just a $600-700 legal document can sort of ensure for you that you won't have to pay all of those losses. Is a great way to go.
But at this point, if I own this property personally,
Right,
and I've owned it, say, for 5 years,
right.
and now I've heard, okay, I should be setting up an LLC. Do I need to then get the property retitled into the name of the LLC, or am I able to keep it in my personal name and say, hey, I'm operating as an LLC now?
Yeah, I'm so glad you brought that up. This is great. So my advice on that is you have one of 2 options, okay? One option is to park the equity that you own in that real estate into your LLC. And this limits your liability to whatever your equity is in that property, because the LLC owns the property and not you. Okay, so to do this, you would file with an attorney. It's got to be an attorney, because there's so much special things that you need to do, and if you mess it up, it could be very bad.
Right.
So don't do this yourself. Don't try this at home, kids. But no, you file a quit claim deed with the Records and Deeds Office. It's just like when you have a closing attorney. This is deed related, so you have to make a deed filing with the Records and Deeds Office. You need to usually have some kind of communication with your mortgage lending bank, because sometimes they will flag it and they'll get ticked off at you and it'll mess up your mortgage. So that's something that you need to talk with a lawyer about. But option 1 is to quit claim your ownership to the LLC, which you also own. That way it's not you owning it personally, and it gives them less arguments to sue you personally for something that went wrong with the land. Another option, I think a better option, especially if you have multiple companies, multiple real estate land that you're renting out, is to separate it. So you would put one property into one LLC, and then you would have an additional LLC that you may or may not own with partners that is for property management only. How this works is the property management company is the one that contractually obligates itself and only itself. And whatever the value of the property management company is, it might just be 5,000 that's sitting in the bank. That might be the total value. So the property management company will give the lease to your tenants, for example. And then your tenants, if they have some beef with anybody about the land, they can only sue the property management company. They can't even sue the LLC that owns the land, because that's an innocent sort of party, right?
Right.
And then you have a contract between the land owning LLC, where you've parked the quit claim deed, the land in, and the property management LLC, okay? And then the tenant. So you have three companies, three entities: the tenants, property management company, and the LLC that owns the land. So it makes it really hard for the tenants to get past the limited liability created for the property management company and sue for even the value of the land. If you have, three or more properties, I highly recommend a property manager.
Okay, so just to recap, if I'm understanding you correctly, you're saying that to set up this additional LLC that's the property management company, and then with any tenants that I would have, the lease agreement is between the tenant and this property management company, correct?
Yes, correct.
Okay, and then the property management company has a contract with the landowner LLC for whatever the fees and rent and so forth are going to be. So yes, we are creating an additional layer of protection there.
Absolutely.
And in that way, it eliminates the tenant from being able to come after me directly. It has to get through the property management company, because that's who the lease is with.
Yes. So if I were, it would be so hard, near impossible to get to the actual individual involved, that who owns the property management company, who owns the real estate holding company, and does all this work. But that individual is so hard. You have to pierce so many corporate veils that, those billboard personal injury attorneys that you see, they're not going to do it because
Right.
they know it's going to be, a very thorny, bunch of, bushes, or I can't make a good metaphor, but it's going to be hard. It's going to be an uphill battle.
So let me ask this in another way also. So if I own the property and my mortgage company bank is saying, yeah, we're not going to allow you to put this property into an LLC, because we want this, this agreement is between, you and us, not an LLC. If I then go set up that management company and all of the tenants for my property now are contractually obligated with the property management company and do that, does that still protect me?
Yeah, it does. It would be best if you could park the deed, the title to the land in a separate LLC, but yeah, you still get a lot of protection. And in my experience, usually banks don't really care, because they have the principal interest in it, in the property. So, if something goes wrong, they can always foreclose on the loan, and they're not going to have to fight anybody else. They won't get your equity in it, or
Right.
you might lose in a lawsuit and give your equity to somebody else, but the bank still gets the land, so they're
Right,
going to
right.
get paid first, and they have a principal interest in it. But yes, that would be far better than nothing, even if you have an issue with the bank, which in my experience is quite rare.
Okay. That's awesome news, because I know so many times that I run into people that have the rental properties, were reporting on their Schedule E because they don't have any type of entity structure or anything else. So this is great news for people to really help be able to protect their assets.
Yeah, let me jump in here with some other advice, if
Sure.
you'll allow me. So as a business lawyer, we've represented a lot of different partnerships in disputes about real estate. So in the world of real estate, there's kind of a lot of transactions that go on, and they can tend to be pretty high value, you know. So for example, you might get a case where there's a general contractor or even a subcontractor that says, hey, let's get into the business of flipping houses together.
Hmm.
You're going to be the money guy and I'm going to be the contractor. So I'm going to fix it up and, you know, hire my guys to, you know, do new drywall and flooring and, you know, plumbing and whatever else. And then you're going to like invest in the company and we'll split the profits of the flip, you know, 50-50,
Right.
whatever the deal is. All of which sounds great, but you know, there are so many elements to that partnership agreement that if you don't put it in writing, everybody's just gonna, you know, once there's money coming in and money to be made, I mean, I have seen so much money go to the lawyers to like figure out who gets what percentage of the money that they make, that it's astounding to me. So the lawyers are the only ones that win
Right.
unless you get this correctly set up before you start doing it. Okay. So in that scenario, you need a way for the money guy to sort of, you know, pull the purse strings or stop the purse strings or take over ownership of the house or whatever it is, if the contractor sweat equity guy doesn't do his job, and vice versa. If the sweat equity guy isn't, you know, isn't getting the money he needs, he has to have for materials, you know, much less to pay some subs or whatever to get the work done. He needs a way to take more equity in the company, so if he's going to invest that himself, right?
Right.
And you know, they need a partnership agreement that spells out when they can put it on the market, you know, who's going to be the real estate agent, or if it's going to be them, you know, if they're going to pay out those real estate agent, you know, sellers fees or whatever, because
Hmm.
that's 6%, you know, across both of them.
Sure.
And you know, what their minimum sale price is and, you know, when they want to sell it and all of these things. If you don't have that locked down tight, then, you know, it can just be a total chaos thing, and chaos is great for employing lawyers
Yeah.
but it's not great for the people who are making these investments. So if you have any partner in any of these real estate developments that you're doing, please, 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 please get a lawyer to help write a partnership agreement, because it's worth its weight in you know, printer ink.
Right.
The
Right.
most valuable thing in the world, per ounce. And it's not a tough thing when there's not money running around, when you haven't made the investment yet. It's pretty easy to do. People are very reasonable, but when you start to get a bunch of, you know, disincentives and incentives in there, people do you know, pervasive things.
Right. So this goes back just like our prior conversation that we had about making sure that you do the proper planning and lay things out ahead of time. You know, just again, doing your operating agreement, you know, partnership agreement, bylaws, whatever it is, to do make sure you have those ahead of time before you actually start doing business. Because if you don't, it's going to hurt you down the road.
Yeah.
And if you are in business right now and you haven't done this stuff, you need to stop and call Jonathan and get this stuff done so you don't end up having trouble down the road, because it's going to crop up sooner or later.
Yeah, yeah, absolutely. And the other thing that we were talking about is with general partnerships. You know, if you don't have a partnership and a limited liability company or a corporation or something else, the default version is a general partnership. And that means that you're totally liable for anything that your partner does in any business or, you know, act
Right.
of commerce or whatever. So if, for example, you want to go into business with a general contractor and this guy, which is common, you know, stiffs some other homeowner, you know, and they take their 50% down payment and they just run away with it, and they owe this homeowner, you know, $100,000, you are liable for that $100,000 unless you have an entity that says otherwise, because the
Right.
default thing is hey, you're general partners, so they can come after you, just like we did in the 1700s. It's super important to get that handled.
Right, right. Man, you really gave us a lot of really good information today. I think that I think that anybody that is listening to this, that if you are thinking about setting up a business or you have one set up and you don't have, your partnership agreement or operating agreement or bylaws, you need to stop and get them done now. Jonathan, how can our listeners get a hold of you if they're finding themselves in this situation right now?
Yeah, we're happy to help. You can email me directly at jsparks, SPARKS, at sparkslawpractice.com, or you can call us anytime at 470-268-5234. Our website is just sparkslawpractice.com, but happy to help. We can help you out in whatever state you're in, unless you're filing a lawsuit at the time, which hopefully you're not.
We really appreciate your time today and look forward to talking with you again shortly.
All right. Thanks so much, Gary. Pleasure to be here.
This show has been produced by Market Domination, LLC. To discover how you can have your own show completely done for you and turn it into a real published book and become the authority in your marketplace, go to www.marketdominationllc.com/podcast offer.